Well, the stock market action we've seen in 2020 has been anything but ordinary. And joining us now to provide perspective on what active traders are thinking about in the market right now is Randy Frederick. He's Vice President of Trading and Derivatives at Schwab Center for Financial Research. Thanks for joining me today, Randy.
Hi, Liz. It's great to be with you today.
All right, well, this has no doubt been a very historic year for the market in so many ways. So what's the general consensus among active traders in terms of the sentiment right now?
Well, I think, the year started out pretty well, and in January things were looking good, and then of course the virus hit and it all kind of went south very quickly. And we came from finishing up the longest bull market in history to the shortest and quickest bear market in history, and now right back into another bull market. Depends on how you measure it. Some people would look at the bull market as having started when we went up 20%. That's typically how I look at it. But by any measure, since we recently, just last week, in fact, hit an all-time high, everybody, regardless of how they look at it, would not disagree with the fact that we are now in another bull market. So the sentiment's very positive. I think in many ways, a lot of the old traditional analysts are looking at valuations and saying, gosh, stocks are really expensive from a historical standpoint, but things are a little bit different now. Part of the reason is that, of course, interest rates are at zero and they're likely to remain at zero for several years. And that tends to push people into riskier assets like equities, which then in turn justifies a higher valuation level. So while stocks are stretched and they are expensive, I mean, the S&P 500's up, 53% since the bottom on March 23rd. So substantial. And in fact, the NASDAQ's doing even better. But most of it has been driven by a lot of those really big cap stocks. And if there's anything that the virus has done is it's exacerbated the difference between the haves in terms of the big, wealthy, mega cap stocks and the have-nots in terms of the small companies that have been struggling to survive in this environment, frankly.
Yeah, there's definitely been certain sectors that have been hit much, much harder than others. So when you're talking about the economic outlook for active traders, how are they kind of using that to almost inform their decisions about what groups, that they are playing as we may continue to see the market move higher?
Right. So the thing that we know is that throughout the majority of the last decade, and even a little longer than that, since the bull market began way back in 2009, technology and consumer discretionary stocks, which are typical cyclical leaders, but more so, I think, technology even than the other, have been the leaders in not every single year, but they've been the leader for the entirety of the bull market overall. And in many of those years, I think it was like 4 or 5 out of the last 10, the technology's been at the top. And we've seen the same thing again this year. This year, at least, it makes a little bit of sense, because the way I've been saying it is that the technology stocks, Silicon Valley, if you will, has been trying to convince us, everyone, consumers, that they were indispensable and that we couldn't live without them for a very long time. Some of us were skeptics. When the virus hit, and many companies, ours included, had to send many people home to work, then we found out that technology was indispensable and we had to have it. And in fact, had these guys not created the kind of abilities for us to stream things over the internet, to link up to our offices, to do all the things that we do from home. In fact, if this had hit 10 years ago, we wouldn't even be able to do what we're doing right now. So all of a sudden we find out that the companies we didn't realize we couldn't live without, we find out that we simply can't live without them. So technology continues to be a leader. It's been a leader for a very long time. And while the NASDAQ index is not strictly technology, it does tend to be very heavily weighted towards the technology stocks. And it's one of the reasons why it's a stronger outperformer. It's up 25% year to date relative to the S&P, which is only up about 6%. So what we find from more active traders is that they're willing to look into big cap tech stocks. And some of them aren't necessarily tech stocks, but we kind of think of them as such. So for example, companies like Facebook and Google and Amazon, they're not all tech stocks. Some of them are consumer discretionary, some of them are communications, but because they're technology driven and we kind of got introduced to them as tech companies, then we think of them that way. So now we find that people continue to put money into the same big companies that have continued to outperform. And while the valuations have gotten very high in a lot of cases, they're justified in the sense that they are indispensable, at least at the moment. And frankly, once we get out of this virus situation, hopefully sometime by the beginning of next year, they will continue to be leaders in all likelihood because they are so strong and they do have so much capital to work with.
Yeah, it's really seemed like almost a tale of two economies, when you just look at the stark contrast between the strength in tech and industries, travel and entertainment and
Right.
and things like that, getting hit really hard. But when you're looking forward at the growth that we've seen for technology, how much longer can we expect that to continue at the rate that we've seen it in this rally, with the extremely strong gains that
Yeah.
a lot of these companies have produced?
Well, that's really an answer no one knows. That's really a question nobody really knows the answer to. But again, because interest rates are so low, many of these companies, even those that didn't need capital, have sold bonds at very, very low interest rates. So they've essentially filled up their chest full of working capital that they now can use, and liquidity that they can use for the next several years at extremely low rates. So they have lots and lots and lots of capital to reinvest in the business, to be innovative, to grow, to add employees, to add new technologies. The ones I would caution people about are any companies that have strictly benefited because of the virus. Those that were not necessarily on our radar screens, that we weren't paying attention to, those companies that have benefited just because we're home. Now, there may be some life left in them, but at some point when we do finally get back on our feet and we get back to something closer to the old normal, and I think, frankly, the new normal won't look like the old normal, in the sense that many of the people who are working at home now, I think, will stay home. Not as many as are home now, but certainly more than were working from home prior to when the virus hit. So to some extent, there's at least some longevity there. But those that have benefited from things like our inability to go to the movies, or to go to a casino, or to go to a sporting event, or to go listen to music or something like that, gaming companies potentially, companies that have forced us to work out in our homes as opposed to going to a gym. Those kinds of companies that have had very sharp run-ups just since the virus hit, I think there may be some caution there in terms of their ability to continue to move higher. But the big giant mega cap companies who were a big part of our lives and growing more and more as a bigger part of our lives even before the virus, have just gotten bigger since the pandemic, and will likely continue to get bigger going forward. So how far they can go, no one knows. Technology sector in general has always run with higher PE ratios than most of the other sectors anyway. And what people often do is they'll look ahead to the next quarter and base the value of what they're willing to pay for a stock now and what the company might earn in the next quarter. That's been impossible for two reasons now. One is that many of these companies have suspended their guidance for the rest of this year. And secondly, we know that those earnings aren't going to come back in all likelihood anytime soon. So I would say that people are paying now what they think a company might be able to earn, say, in 2021. That's a little bit further out into the future, but that's sort of how the virus has kind of changed our perspective and our time horizons, and more recently, because it's just forced us to look out further than we might have otherwise.
Yeah. And what's your advice for active traders in terms of how they should be thinking about different moves for their portfolios when we see very news-driven events? We have an election coming up, coronavirus vaccine talk. I mean, there's a lot of different headlines that are still looming that could really move the market. So what's the thought process there for how to handle those potentially big shifts in market conditions because of that?
Well, I think the most important thing of all, and this is something now, I am Schwab's short-term analyst, so I do speak to people who trade a little bit more actively. But one thing I always emphasize, because this is very important, is that if you trade actively, you should not be trading actively with your entire portfolio. I believe, and we believe as a company, that everyone should be an investor, and that means have a very long-term time horizon. If within your entire portfolio, you want to carve out a portion of your portfolio to trade more actively with, I always say that should be no more than 20%. So within that 20% that you might be trading more actively, by all means, you can be news driven, you can be event driven, you can trade based on up or down moves in volatility, all the things that we've experienced this year. But don't make wholesale changes in your overall portfolio, your long-term investing based on things like the election. The best example, I think, is that there was a very, very strong sentiment prior to when President Trump got elected in 2016 that it would be a big negative for the stock market. Clearly, that has not been the case. In fact, if you compare President Trump to all of the presidents since World War II, the performance of the stock market under his term has been fourth best out of all the presidents since World War II. So that's pretty good. Now, it was in an uptrend when he came in, but even then, he has outperformed the trend that was created under Obama for his period, his first 4 years. So I think that's a there's a big, I think, belief right now that potentially maybe a Joe Biden presidency might be negative for the markets because potentially he wants to raise taxes. I'm not saying that's right or wrong. I'm saying don't just assume that that's the case, because it may not be the case at all. In fact, what markets have historically liked best is when we have, it doesn't really depend on the presidency. It depends on what the makeup is between the presidency, the House, and the Senate. Generally, if there's a mix where you have Republicans in control of at least one of the three, or Democrats in control of at least one of the three, then the changes in government tend to be rather subtle and fairly slow and somewhat more predictable. The market generally likes that. When you have a Republican or a Democrat in charge of all three branches, then that tends to cause a lot of volatility in the market, because it opens the door for significant and very radical and very drastic change, which oftentimes is very disruptive to the market. So I would say, based on the election, those are the types of things that are more important than just who becomes president.
Interesting. Well, thank you so much, Rady, for providing your perspective today. We really appreciate it.
You're very welcome.